So if that's a bear market, let's say that descending channel is 6 months in the making, and we're coming off the bottom of it, so there's a buy opportunity.
In this interview, I'm sitting down with Cary Artac. Cary is a trader who's been working on the Chicago Board of Trade with nearly 30 decades of experience in the market, providing technical analysis for the big institutions and traders. He's really one of the best analysts out there. So Cary, welcome back on the podcast, and tell me about what you go through these days.
Well, I think as I was telling you before we started recording, I've been a commodity trading advisor. I've had Artac Advisory Incorporated since 1996, and that was coming off of about 10 years on the trading floor. I initially started in the options markets, the Chicago Board of Options Exchange, for 2 or 3 years, where I learned spread strategy and option pricing formula and so forth. But I never really understood the underlying dynamics of any particular market. I never studied that. We had the stock market crash in '87, and that really sort of hit the options markets very hard. And I was still very new as an apprentice. So I then moved across the street to the Chicago Board of Trade in 1989, where I got a job actually with a large-scale 30-year Treasury bond futures trading company, and they hired me because of the options experience that I had across the street. They didn't really have any options experience. As it turns out, I learned more from them than they learned from me. They had a kind of a war room, if you will, of 3 different technical analysts who were studying, intraday 5, 10, 15-minute bar charts, moving averages, stochastics, RSI, so forth, the oscillators. And then they would call the information down to the trading floor, and the traders would use that in the trading pit to, execute trades either on the buy or the short side on an intraday basis. And so, looking over their shoulders over time, I became fascinated with the whole idea of analyzing the markets technically, and just devoted myself to that science. It's as much of an art as it is a science, in my opinion. And within a couple of years, I developed my own reputation on the trading floor for being a skilled technician. Someone who could, determine price support and resistance levels, directional probabilities over the short, medium, and long term. In fact, I think one of the unique things that I was doing even on the trading floor, when most of the traders in the trading pit were it's beyond day trading in the trading pit. I mean, you're buying and selling constantly. So you're not even really looking for the setup of the day when you're in the trading pit. But I was looking at bar charts that were going back 30 years. I was looking at patterns that were going back decades, channel structures, trend lines, moving averages, Fibonacci retracement levels, et cetera, that were much longer term in scope. Because, when the market would approach some of these critical points, I don't care what kind of a trader you are, whether you're a day trader or whether you're a long-term investor, these are the price points that matter. You can trade those levels profitably. So if by the mid-90s, with the advent really of the internet and file attachments, I began to see that I could actually work from home. And that's when I started Artac Advisory. So I've done trading as much as advising. But there's an interesting phenomenon I've always found. When you're advising people on a particular market, you have to be very careful about the extent to which you are personally committed to that market or personally invested in that market. The more I'm invested in a particular market in terms of my portfolio or my trading account, the less objective I become in my analysis. It just seems to kind of go with the territory. So if I've got a group, maybe dozens of people following my opinion about a particular market, I need to be very careful the extent of which I'm personally committed to that market, because I can lose all objectivity the moment I'm completely devoted to it. So I've learned to trade and invest in the markets that I don't publicly provide analysis to. And there's so many markets out there, you couldn't possibly trade all of them. So there's plenty to go around. And also, because I'm really devoted to my craft and I'm devoted to providing good analysis for the trading public, I can't day trade and provide good analysis at the same time. There's just not enough energy, for me anyway, personally. So I've learned that my trading is more like the 3 to 5 week out to the 3 to 5 month time horizon. I'll see a stock set up for a buy signal that I might see could play out 20, 30% gains over the course of time. With the more volatile stocks, you could get a 20-30% gain in a matter of days or in a matter of weeks. And then in your more kind of your larger cap S&P 500 blue chips, it could take a matter of months. And those are the kinds of trades that I execute. And so I've been doing commodity analysis for many years, crude oil, the grain markets, the livestock markets, the energy markets for just about 30 years. And that is still a big part of my life. That is probably my primary vocation. But in the last few years, my daughter, who's now 28, was coming out of school. And she didn't really have a whole lot going on in the middle of COVID, was searching for something to do. She had some web design experience, and she said, Dad, you should start providing analysis in the stock market. She goes, just about every guy that I know in his 20s is attempting to trade the markets right now, day trading, which was a big phenomenon. I remember in COVID back in 2021. You had a lot of 20, 30-something guys sitting at home trying to have a go at trading. And some of those are still our clients to this day. And, initially it was just providing a couple of stock picks a week. And then we quickly found out that there was a strong demand for like the SPY and the Triple Q, the S&P 500 ETF, and the NASDAQ 100 ETF. So we provide daily analysis in that. It's all video based. We do provide highly specific support and resistance levels that are correlated with time horizons. So we got day trade levels, and then we have those levels that you really want to step into if you're kind of a 2 to 3 week, 3 to 5 week position trader. And we weight those levels accordingly. And I talk people through the video. Each video is about 5 or 10 minutes. We do a couple stock picks a week. We do daily SPY, daily Triple Q. And we also have a YouTube presence that we found has been a good generator of new subscribers at wickedstocks.com. Wicked Stocks YouTube channel provides daily analysis in Tesla and NVIDIA. And most of those are swing traders, day traders to swing traders. There are some longer term investors, but I don't know if that answers your question or not.
Yeah, definitely, for sure. Tell me a bit more about how you got your start in trading. You told me you started at 23 years old. Did you have interest for trading before that, or what got you started exactly in the market?
I've always been fascinated with the markets and how they're all interconnected globally. And, I grew up in the Chicago area. So the Chicago Board of Trade has always been a big element within the city of Chicago and the Chicago Mercantile Exchange. At the time, those were two separate competing entities. And I met a fellow who was a successful stock options trader. He was trading spreads primarily, back spreads, ratio spreads in the OEX, that is the S&P 100, options pit. And so he was looking for a clerk, someone who could help him out. And he was ideally looking for somebody who didn't have any experience whatsoever. He just didn't want any preconceived notions about the way the markets ran. He really wanted to sort of teach me himself. So I spent a couple of years doing that. And the idea was that I was going to graduate to trading, and he was going to back me financially. But my timing was 1986, early 86. And by late 87, as I'm getting ready to start trading, I was assuming the stock market crash hit. And that was a big deal for the options market in Chicago. It really decimated that particular market. Many traders went out of business. Volume dried up for several years. When it regained its footing in the early 90s, it was a different market that was dominated by large banks. And so the spreads between the option prices narrowed. It became a much tighter, more efficient market. You didn't have this sort of sloppy inefficiencies that allowed the floor trader back in the early 80s to profit substantially anymore. That day was gone. And so many of the successful options traders had a tough time making a living. And that's when I made my transition into the futures markets, where I actually became more fascinated with understanding underlying market behavior by analyzing that market itself. So, when I was in the options market, and we were trading the S&P 100, you really didn't care about the market direction. You responded to it, and you're always kind of delta neutral in your spreads in the options. And so it was almost irrelevant as to what the directional market would be. You'd prepared for the upside or the downside. But over at the futures market across the street, knowing market direction, having a sense of what the likelihood would be was everything. And so I really, became fascinated with that whole subject. And I did start trading back in the late 80s, early 90s, and I did well. But the funny thing is, I had to sort of make this choice between analysis and trading. And while I continued to trade uninterrupted for the last 30 years, and it's a substantial part of my net worth and my portfolio, it really was kind of my passion has been in analysis. And as I was saying before, the analogy that I like to use is like the coach on a professional football team. He's not out in the field. He's not scuffing it up. He's not, running or throwing the ball, but he's certainly cued into what the player should be doing. And that's kind of the way I view my work. If the coach is on the field, he loses his objectivity as to what the big picture looks like. And as an analyst, as somebody who provides market information and directional guidance, I just find that I do a better job when I'm not heavily involved in the markets that I'm covering. I do trade other markets, but every day I put out analysis in my commodity letters, crude oil, live cattle, corn, wheat, soybeans, those kinds of markets that I don't really trade anymore. I just analyze because I've got a lot of large-scale commodity producers in North America who are relying on me for good information. And so if I see a long-term sell signal, let's say in crude oil, there's a part of me that really wants to act on it. But I know the moment that I get heavily invested in playing the short side of crude oil, my bias is going to skew subconsciously to the downside. And that's an interesting phenomenon. I think any of your followers, your listeners who trade the markets and analyze them simultaneously, they understand that they can analyze a market all day long and they feel they've got a good handle on it. But the moment they get invested in that market, the trading psychology kicks in. It's maybe fear. There's certain elements that disrupt the ability to really see that market objectively. Most of my trading now is in the stock market. And like I was telling you before, because I don't have the time and energy to devote to day trading. Day trading and swing trading takes a lot of energy. And anybody who participates in it knows that. It can kind of wipe you out by the end of a day. And so you have to do one or the other. So I analyze, I produce newsletters, I provide analysis, but I also do my own longer-term trading. I call it near-term investing, where if I see a particular stock is setting up for a buy signal, I will act on that. I also have my own rules in terms of my portfolio. I break it down into about 10 individual stocks. I don't like to lose more than 2% of my trading capital on any particular trade or endeavor. And so if I don't commit more than 10% of my portfolio to any particular stock, that allows that stock to drop in price of 10 or even 20%, which is a rarity before my 2% stop loss, my worst case stop loss is hit. Most of the trades that I exit on a loss they represent less than 0.5% of my trading capital. So I've got, like some of the people who join Wicked Stocks and they start trading and adding some of the stock picks to their portfolio. Our recommendation is to, just add it over time. And within a matter of several months, you may have 10 individual stocks roughly that comprise your portfolio, all of which are buy side recommendations. For me anyway, 10 stocks is about enough to wrap my brain around. I'm a discretionary trader. I'm not a systems trader. And so to have 15 or 20 or 25 stocks going at once, that's just too much for me to sort of contextualize and be able to hold on to mentally. So 10 is like my magic number.
So when you say you analyze stocks or markets, what are some things you look at? Is it like always the same factors, or do you have different tools, different things you look at for certain assets that are different than other ones?
Well, I learned, this is so funny, when I was in the trading floor back in the late 80s, early 90s, I poured through so many books on technical analysis, and I talked to so many of my colleagues on the trading floor. Some were doing this, some were doing that, some were doing GAN, some were doing volume analysis, others were following market profile behavior. There's a long list of methods that you can employ. What drew me into why I like what I like is, I don't know, but I thought that channel structures visually made a lot of sense to me. that the markets like to behave in particular channels. In other words, if the market is in a bear market, there will probably be a parallel series of lows and highs that it's behaving within. I also like speed lines. Secondarily, as a backup, I like Fibonacci levels. But what I really like to do is combine the near term with the long term. In other words, if there's a long-term resistance level on a 30-year chart, let's goes back several decades, and we're approaching it, and if it happens to coincide then, let's say with on the daily chart, you have a rising channel top that is now intersecting with that area, that's going to be a big pivot point for the market. And those are the sort of symmetries that I'm constantly looking for. So I use classic chart formations. That's kind of the way I would put it. I look at bar charts. I look at key reversals or bearish or bullish engulfing patterns as they use in candlestick speak. But I just carefully and meticulously study the chart. And my primary mode is the channel structures. And you can create channels over the course of 2 weeks, 2 months, 2 years. You can create a variety of them, and the art of it all is putting it all together into cohesive framework so that it's understandable, so that you can determine what's important, what's not, what is primary and what is secondary.
And would this channel be used for, let's say, like continuing within the trend, or will people use them for what kind of reversal when price breaks the channel, or what kind of things people can use with that?
Absolutely. So I show all this in my analysis. I've always been a big believer in transparency. I think a picture is worth 1,000 words. I could write 2 pages and still not be able to express fully what somebody might see with a channel that's well crafted. And channel structures can't be created. I see a lot of them are just sort of roughshod, approximate locations. I'm very precise in my levels. So if there's a series of lows and highs that are run parallel with each other. So if that's a bear market, let's say that descending channel is 6 months in the making, and we're coming off the bottom of it. So there's a buy opportunity. When we come to the bottom of that channel structure, it's a buy opportunity. When we rally to the top of that channel, it is a profit-taking opportunity. It also is an opportunity to get short. And so when we're hitting a top of a long-term channel top that is still within the confines of that long-term bear move, I will suggest to my traders and my subscribers, this is an opportunity to buy out-of-the-money puts that actually may be consistent in strike with the channel bottom, because channels tend to sort of operate, the markets will trade inside of a well-defined channel, and they can do it for a protracted period of time. And of course, if we close above that channel top, that is a magnificent buy opportunity. This is the other thing that I've learned a long time ago. When in my early days, let's say the market closes above that channel and it hesitates and it doesn't rally, and then it falls back and closes below that channel. It used to be, I thought, well, what went wrong? There's something wrong with my analysis here. I just don't have a handle on it. And I stopped invalidating myself about 20 years ago, and I realized that the market is telling you something. That was a classic buy signal. That was a valid long-term buy signal, but the market is telling you not so fast, not interested in going up at the present time. And the fact that it closes back below that channel top and falls back inside the confines of that former channel is an indication of a sell signal. So I have this saying that a buy signal rejection is in itself a valid sell signal. So I use that all the time in my analysis, and it works quite well. But most of the time, if you've got a well-defined channel and you close above it, I'd say 60 to 70% of the time, you're going to get the expected rally. And that's kind of what we set up for. And you can develop these channels, like I was telling you, I create them all over the place on any given chart. In the SPY, the S&P 500 ETF, you can create a channel over the last 8 to 10 trading days. You can create, that could be a descending channel that, if settled above, would mark an end to that 2-week bear market, and then you've got longer-term bull trend resumption. You can also have, we hit a long-term channel bottom in the SPY in early August, almost to the very tick. and it's a 1-year channel structure that comes off the October low of last year. And this market, the SPY, the S&P 500, is now operating to the upside in a very well-defined rising channel structure. And so we're expecting higher trade. Since the August low, we've been telling our subscribers that the channel top, which is well above the market, but we're much further closer to it than we were just a few weeks ago, is the ultimate 2 to 3 month objective. And inside that 2 to 3 month bull move, you've got all these little short-term sell signals for 3 to 5 day swing traders that we identify. So I think the art part of technical analysis is being able to combine the long term with the short term and to be able to create sort of a cohesive framework. The long term generally wins. That's rule number one. So in the case of that 1-year channel bottom I described that the market tested in early August and has since been rallying off of, that is your primary trend. That is the one you really want to respect. And if the primary trend, the longer term trend, is bullish, and if you're a swing trader, you're more leaning toward the buy side. You're taking advantage of those near-term buy signals that exist within the confines of a long-term bull market. And the inverse would be true as well. If you're in a long-term bear market, you're more likely to act on those near-term sell signals that take place within the confines of a longer-term bear market.
How do you make, like you mentioned, a channel more precise? Because it's one thing to get, like when you try to draw a line and make channels, everyone could probably do it, but what makes it different the way you do it, like where it's more precise?
Well, I use the extreme. So I use, it's a mathematic for one. You have to have the right software, in my opinion. Now, for years, I did it by hand. I had software that could go from, let's say you've got a low, let's say we're just going to make up some stock and it's trading at a price of 50 and it drops to a price of, let's say 30. And then it rallies to a price of 40, and then it drops to a price of 20. So you've got now this descending trend line from the 30 to the 20 low. So you're going to take the spread between those 2 points. If it's 10 days, that's an easy one. So now it's dropping 1 point a day, right? And now you're casting a channel top off that intermediate high. So if it was down to 30, up to 40, down to 20, now you're creating a channel top off that 40 high, and it's dropping 1 point a day. And so I'm looking at the extremes. Let's say that when it dropped to that price of 20, maybe it spent a few days down there. It dropped to a price of 20, maybe it dropped to then a few days later a price of 19, and then it continued higher. Well, you're still using that 20 because if it's dropping 1 point a day and 3 days later, that trend line is going to be at a price of 17. Even though you took the low out, it went down to 19, you're still using that 20 low. I don't know if that makes sense or not. Here again, it's a picture's worth 1,000 words, but it's very precision oriented. Most of the channels do not rise or fall at a perfect 1 point a day. It's like 0.65 or 3.72, and then we follow them. I use a software that I've used for years called Commodity Quote Graphics, and it's called CQG. And I can actually take my cursor, hit a low, hit another low, and it tells me immediately the exact rate at which it's rising or falling. And I can create channels that way as well. So for me, it's a very manual process, but if you have the right software, you can create these things in no time, which is what I do every single day in my analysis. And I don't know if I described it properly or not, but there is I use the extremes. So for instance, if I'm drawing a trend line across a series of lows, I'm grabbing the extreme lows. I'm not drawing a trend line where one of those low points falls below that trend line. If it does fall below that trend line, then I'm using that low, if you follow what I'm saying. So I'm grabbing the extremes on the sequence of lows, and then I'm projecting that against the extreme high. This allows for the worst case scenario channel structure. It is the last channel that could possibly exist, and it is probably the most valid one. Now, you could create some that are inside that by a degree that might give you an early lead on a buy signal if you take out that channel top. But I would prefer to wait for that last channel to be violated before assuming that bear trend that preceded it is actually over.
When it comes to time frames, do you have any preferred time frames to do this? Maybe a daily chart, or what's your go-to for this?
I use daily charts, weekly bar charts, and monthly bar charts. But my analysis that I present to the public is day to day. When I get into a trade myself, let's say that I'm looking at a daily chart and there's a 3-month channel top coming down that we are beginning to approach. Or let's say that we hit the channel top, and maybe I'll sell some, but not all. And the market begins to back away from that channel top. I'm a little bit short. I'm not fully loaded on a short position just yet. I don't like to go all in on the buy or sell side. I like to scale into my trades 30%, 50%, and then wait for some sort of confirmation. The confirmation now will be to the downside, and that's when I will begin to look at, a 30-minute bar chart to see what are the intraday dynamics showing. Do we have an intraday sell signal following the testing of a long-term price ceiling? And if some traders won't sell that rally at that resistance level, they will wait for the downside confirmation to sell on weakness. It is a higher probability trade, but the problem with that, of course, from my perspective, is you're giving up a price location. So if that channel top, let's say, is at a price of 37.50, I'm just making this up. So we test the 37.50, maybe we go to 37.6, and then the market begins to fall away. And now you're looking at your 30-minute bar chart, and you've got a solid sell signal if we break the price of, 35 or 35 and a half. Okay, so we break the 35 and a half, you go short at 35 or 34 and a half, let's say, but you know that in your mind, you could have sold it when we were testing the channel top, at that, 37 or 37 and a half. So I do, just for my own trading psychology, I like to step in and aggressive. I'll buy a falling market, I'll sell a rising market, but I'll do so just very carefully and I'll scale into it. And then if I've got confirmation that I'm right, then I'll step in with the rest.
Interesting. So yeah, waiting for confirmation, I think, is a big topic. You probably get guys maybe who are a little bit younger who get into trading and they, for some reason, kind of seem to make it work for like the first year or so. They're still losing money. What do you recommend them to do to flip this around, to get to a point where they can actually get some more consistency in the markets?
Well, risk management is key. I can talk channel structures and trend lines all day long. I can talk about the right, proper trading psychology, but it really comes down to having a respect for the markets and that your commitment is toward capital preservation. It is a defensive mindset. And so having a stop losses, the moment you enter the market, you've got a stop loss. You might think you've got all day to enter that stop loss, but anything can happen in the world, and pretty soon, you're upside down. And so having stop losses at play, good till cancel stop losses if you hold positions overnight. These are worst case stop losses. So they are the 2%, let's say, of your total trading capital. They should be well away from the market. And then, you can change that stop loss over time. So I think giving yourself that year, considering that trading is your advancement as a trader is a process. It really is. You have to consider it. You're like in a university, you're in school, and you're really trying to preserve your capital. I see the biggest mistake made, especially with wicked stocks, the stock side of my analysis, is just traders who is kind of the gambling instinct. There's nothing wrong with the gambling instinct, but if it's not coupled with a respect for the market and using risk management. So, having a risk management strategy that you devote yourself to, that you follow very disciplined, is the key to good trading. It always has been and it always will be. So, what is your maximum drawdown? How are you going to get into a trade? How are you going to get out of a trade? Are you going to sell strength? Or are you going to wait for the market to fall away? You're going to sell weakness. Are you going to buy weakness? Or are you going to wait for the market to rally away and buy strength? And that's trade execution. Having that kind of mapped out, and it can be experimental. Should be experimental, but there should be like a worst case drawdown that you'll never go beyond. There should be a maximum margin to equity ratio. There should be a maximum, how much of your portfolio should any particular stock comprise as a ratio. Should it be 50%, 100%? Should it be 10%? These are the little rules, the risk management rules that need to be determined in advance. And there's another rule that I always like to follow, and I don't really have to anymore because I haven't really needed to change my rules in many years. But one of the rules is never change your rules while you're in a trade. That's a classic mistake too. You can go from a day trader to a long-term investor because you forgot to put your stop loss in, and now you're waiting for that stock to come back so you can just break even. And it might take days or weeks, and you're paralyzed. It then affects your trading psychology. So one of the methods for keeping a well-balanced trading psychology that is not vulnerable to the extremes of fear and greed is a disciplined approach to risk management. Just being able to manage your money well, intelligently, and conservatively in the marketplace. You have to have a healthy respect for the market. And if you're going to take these little razor cut losses, small losses, but every now and then you're going to do a trade that reaps wild gains. That's really going to make up for all those little losses you may have taken. And you have to have that sort of wherewithal, that sort of discipline. And you can take a series of small losses, 1 to 2% of your total portfolio. You can do that 3 or 4 times, 5 times, 7 times in a row before you get into a nice winner. But if you allow a trade to occupy, say, 5 or 10% of your portfolio. If you get into a trade and within an hour or a day or a week, your portfolio is now down 10% because of that trade and you're not out of it, all you need is 2 or 3 of those and you've got a bad year going. So once again, you got to play defense. And then staying in a winning trade. If you've had a series of losses, the impulse is to, I'm in a good trade now, and I've lost 10% of my portfolio in the last couple of months. Now this one trade, I'm break even on the year, so I'm going to get out now. That's also the wrong thing to do. You don't want to get out just because you're breaking even on your underlying capital. You want to trade each trade in particular. You want to wait for your objective to be reached. This is the discipline of trading. So if you buy, let's say you've got a breakout in a stock, you've got a price ceiling at 25, you close above 25, now you see 40 is a real possibility over the next couple of months. You want to stay in that trade. You don't want to get out for any reason that might satisfy some underlying equity concerns at a price of 30 or 35. You want to patiently wait to reach your 40 level. There's also, in terms of technical analysis, the market doesn't always reach its objective. And then that's when you have to determine, and this is not so much risk management, but it's the technical analysis. When is the trade over? It doesn't look like it's going to reach that objective anymore. So what are your rules for getting out? Once again, I can tell you that there's probably going to be a rising channel bottom that comprises the last several weeks of activity that you can find on a daily chart. That's just an example. One of the classic sell signals that I use just in pure, simple bar chart analysis, you can do this on a daily chart or a weekly chart. But if it's a weekly bar chart, and I'm getting into a long-term trade, and I see that the market closes above that price of 25, and I think it's going to go to 40, and let's say it goes to, price of 32, and on that particular week it hits that high of 32, and let's say the low of that week is a price of 29. The following week, we break that 29. We close below that 29. That is an indication for me, if I don't get out of the trade entirely, I should at least lighten up on my position and take some profits. So it's closing below the low of the high or closing above the high of the low, these extremes. That works quite well with bar chart analysis, especially on the weekly bar chart.
Nice. A lot of good value these past 2-3 minutes, so people can definitely take away a lot from this. Tell me where people can find you or connect with you after this interview. Where can they see more of your work and what you do?
Well, I work with my two 20-something kids. My son is now an analyst. He's got a mathematics degree from Colorado State. My daughter does the web design. So they work with me, and my son helps me with the charts. He gets out ahead. He combs through hundreds of charts, and then he dishes them up to me, and we spend a little time on Zoom. We don't live near each other, so we'll spend time on Zoom going over our charts, and then we determine what are our stock picks going to be. We do daily SPY, daily triple Q analysis. Also on YouTube, they can find us. YouTube, Wicked Stocks YouTube channel. They can see our NVIDIA and Tesla analysis every single day. And then on the buy side, on the subscription side, wickedstocks.com, we've got the SPY, the Triple Q, and 2 individual stock picks a week. We look at some of the big names, and if there's a buy opportunity in any of them, AI stocks, et cetera, they can go to the website. We offer a 5-day free trial up front. So if they subscribe to our service, they can check everything out for 5 days. And if they don't like what they see, they can bail and exit at no cost to them whatsoever. If they want just a taste of our work, they can go to our YouTube station or our YouTube channel. And the last thing I'll say is on wickedstocks.com, halfway down the page, we have Wicked Stocks Insider. And that is a free service that we provide, 1 or 2 stock picks a month. Provide us your email address. We just did the TLT earlier this week, which is the iShares 20-year Treasury bond ETF. Very interest rate sensitive, of course. It's the inverse of the interest rate market. We had a buy signal in that a couple of months ago. We're now reaching our objective, which basically means longer term, the interest rate market is still one of going higher, but not in the immediate future, of course. But I think by the first, second quarter, we could actually see higher rates again.
That's good. I'll put those links below. People can check it out in the description of the podcast and the show notes as well. I appreciate your time here, Cary. I think it's been a lot of good advice you give to the listeners. So hopefully I can reach out to you and connect with you. And we can talk soon about trading again.
Thank you. I appreciate that. That would be great. You have a great day.